part 6 of Wall Street's hostile takeover of America's real estate market, where we are tracing the history and evolution of Wall Street's interference in our housing market. I am Jen Nodine. I'm a licensed mortgage loan officer in North Carolina. I have been in this business for almost 30 years, and we haven't even gotten to my era of the business yet. So let's get into it. We left off in 1982 at the beginning of the savings and loan crisis. Savings and loans across the nation are beginning to collapse, and Salomon Brothers buys their mortgages at discounted prices. And they're buying whole mortgage loans at this point. God help us. This is where I need to educate you on the critical differences between loan products, but don't worry, this isn't gonna hurt. I'm gonna make it easy. It's really all about mortgage insurance. The bank basically says, look, we don't trust you to pay us back, but if you can get mortgage insurance, then we'll give you the loan. Because mortgage insurance is a guarantee to the lender that they will be repaid even if the borrower defaults on the loan. When you're applying for the mortgage, you're really applying for the insurance. And if the insurance is approved, then the loan goes through. There are many different mortgage insurance providers available, but they all fall into one of two categories, either government or private. So government insurance providers are FHA, VA, and USDA. That's all they do. They just insure the loan against default. They don't set interest rates, they don't lend money, they don't buy and sell mortgages. They just insure the loan against default. Private mortgage insurance does the same thing for conventional loans. And private mortgage insurance is issued by a number of different insurance companies. Simple, I told you. Now the secondary market. The type of mortgage insurance that's on any given loan will determine where it gets sold on the secondary market. Government loans get sold to Ginnie Mae. Conventional loans with private mortgage insurance get sold to Fannie Mae and Freddie Mac. Now, underwriting. Each insurer for the government insured loans has their own unique set of guidelines. In fact, each one of these government insurance programs is unique and very different from the others. And so each one of them are going to have their own underwriting standards, which we call guidelines, that they set. And lenders employ underwriters who are delegated by the government to underwrite mortgage loans on behalf of these government insurance programs. On the private mortgage insurance side, because there are so many different insurance companies offering the same or similar coverage, they don't set the guidelines. They defer to the secondary market investors' guidelines. That would be Fannie Mae and Freddie Mac. So for any loan that has private mortgage insurance on it, it's going to be sold to either Fannie Mae or Freddie Mac. Their guidelines are similar, but not the same. They do have nuances that, sometimes a deal will work with one and not the other. And those loans can be underwritten by anyone in the lender's employ who they deem appropriate to do so. Now stay with me for one more. Come on, you can do it. Securitization. I know. Trust in mortgage Jenny to make it painless. Ginnie Mae, Fannie Mae, and Freddie Mac buy mortgage loans and then turn them into tradable securities. Ginnie Mae handles all the government insured loans. These are the cream of the crop because even though these tend to be riskier loans, they're insured by the government. So there is the least amount of risk in Ginnie Mae mortgage bonds. Because Fannie Mae and Freddie Mac set their own guidelines that are backed by a private mortgage insurance company's guarantee for payment, these are also very low risk investments, but not quite as good as the Ginnie Mae's, for the simple fact that a guarantee from a company is nowhere near as good as a guarantee from a government. See, told you I'd make it easy. Pop quiz. What do all the mortgages being bought on the secondary market and securitized have in common? If you said mortgage insurance, hooray, you got it. Nice paying attention. 1982, every mortgage being sold on the secondary market and securitized has mortgage insurance. This whole process of securitization for Fannie and Freddie at this point in time is brand new. The early 80s is when they first begin to engage in securitization. Louis Ranieri takes credit for setting all of this up and getting it all legalized. Before they did that, they were basically just warehouses for loans until they were paid off. So in the early 80s, when Fannie Mae and Freddie Mac begin to securitize, the loans that are being securitized all carry an insurance guarantee that protects the lender in the event of a borrower default. They're considered such low-risk investments that these are, at this time, they are deemed appropriate for things like pensions and retirement funds. Here's the thing. The savings and loans need to keep plenty of mortgages on their books because that's a source of revenue for them, but they have no intention of ever selling the mortgage on the secondary market. They just plan to keep it on their books forever. They can lend without mortgage insurance. They don't have to follow any particular guidelines. Many of them will set their own. The savings and loans can justify charging borrowers higher interest rates on non-investment quality mortgages that have to be kept on their books. I am sure some of the struggling savings and loans found this to be a welcome source of higher profit margins in a time when they needed all they could find. And these uninsured, uninsurable mortgages are the precursor to subprime mortgages. Fun fact, AmeriQuest Mortgage started out as a savings and loan in 1979. Let's let all that marinate for a little while because you're going to need to know a lot of this going forward as the story progresses. Until next time.